All right, welcome everybody. Let's get right to it. It's Enrico Janko. I'm the Signal, and we're going to go over at the money in the money trading with our boy this morning. This is the weekend edition lesson, and we're going to go over once again. We're going to go over at the money and in the money trades with our boy. I make the distinction between the two only because of the risk reward and the money factor, the profit factor involved in them. In actuality, for myself, the in the money trade and the at the money trade are really the same trade. I'll just let's go through this one particular trade that I was able to record last week. We'll be able to go through this trade. Let's get to the beginning of this, I guess. Hopefully we're at the beginning of this video, maybe. Hold on, let me see. I don't think we're at the beginning. All right, now we're at the beginning of it. This was on December 30th, I see, at 7:30 p.m. This was a night trade. All right, and we got in at 56.25. And let's go over the reasons why we decided to get in this trade. This trade has a minute left on it. And being that it is at the nighttime, I know that most likely it was a slower paced market. And if you look at the max profit, max loss on here, you see a big difference. Almost $20, more than $20 difference, almost a $24 difference in what we would usually lose if we lost a trade, and considered to what we would profit. Usually when we profit $12 to $15, right, with a loss of $85 to $88. With the at the money trade setup, you only lose $56. You only lose $56 if you decided to take that and profit a full $43.75. Big thing about that profit is the fact that look how, first the size of it. It's almost 3 times, of what you usually get in your profit on your regular in the money trade for once. Maybe if it's not 3 times, it's at least 1.5 times, right? And the only issue you have with these trades is that your confidence, you're going to be wondering, is it as strong? Are you going to hit the win rate like you do on your in the money trades? That's what the concern is, right? But that concern really should be lessened, because really, if you're doing these at the money trades, right, you should be hitting them at a good rate. So if you lose, remember you're losing a lot less than you did before, right? So if you're hitting this, you only need to hit 2 out of 3 with these, right? I believe it's like 70, something like that, or 2 out of 3. You hit 2 out of 3 of these, you're in a good space, because your max profit would be 80 and change, and your loss would be 50, right? And you still get a 30% profit on the dollar with the trade. All right, so those are all the reasons why these are pretty good trades. But let's go into how they even come about. What are we looking at for them to come about, right? So we know this is the 7:30 trade. Let's look at what was going on at 7 o'clock. In this particular example, I've noticed that if I go into I'll show you once we get there. But first we'll start let me look at the 15 minutes to show you what I'm just looking at. I want to start from the top really quickly. If I was just looking real quick, 7 o'clock. This is actually 5 o'clock. This is not what I'm looking for. I need the 7:31. Let's get to there. I'm at the wrong time here, I believe. 12:30. I need the 7:30, right? 7. Why does this keep going to the 5 o'clock one? What is that about? Let's try it one more time. I know I put 1900. Why does it keep going to 1700? Anyway, let's just manually move it. Our trade is about this area. Our trade is at 7:30. All right, here. This is the 7:15 candle, which would be the 7 close at 7:30. It's lined up right about here. All right. All right. First thing I'm looking for. First thing that is important to me. First thing important to our boy. This is the same thing at the 5 minute. Let's get right to where we need to be. 19, right about here, 7:25. Here we go, right there. Okay. Just want to get it all lined up for you so you could all see it in the 15 minute, 5 minute, right there. And then if we go right to the video, we're going to see what's going on the 1 minute. All right. So you got 3 different time frames there. First thing, my first tip off. All right. We're going to have 1, 2, 3, 4. We're going to have about 5 tip offs. Right. These are 5 little pieces of information that the market is going to give you that's going to tip you off on whether you can take the trade or not. All right. This is 5 little pieces of information that I like to look for. I don't know, what anyone else looks for, but this is what I like to look for. First tip off for me. The first minute and a half of movement in the market. Because what is important when we're looking for at the money and in the money trades? What's important? What's important to me? The side that is dominant. I need to know what side is dominant in the market right now. That's important to me. Who's the strong guy? Who's the burly chick? Who's the one that is, holding it down? Who's dominant in the market right at this particular time? All right. So that's the first thing I'm looking for. So our first tip off in that first minute and a half, I want to see how it hops out the gate. All right, that's the first tip. Let's see how it hops out the gate. This particular trade right here, we go to about the 3 minute point in this, and look, we see that when this trade hopped out the gate, right, from 9:25 to 9:30, right, we haven't completed it yet, right. Still got a minute and change left. Anyway, when this hopped out the gate, what did it do? It showed strength. It was buying, right? It was buying. And we looked at the area that it was buying in, all right? It was buying at a price level of about 26.90, 26.91, around that area, right? So 26.89. So we know all automatically right now that out the gate, when the binary started off, they were buying. And if you remember from the last lesson on at the money and in the money, I specifically talked about that there's 3 stages of a binary, right? It's the beginning, the middle, and the end, right? The beginning is when we set it off, when it's set off. The middle of the trade, more like about the 3 minute, 2.5 minute mark, and then you have the end, which is about the 1 minute 20 mark, something like that, right? All right, so you have those 3 points in a trade. Those are just 3 times in a binary option trade. All right, so the beginning, this is my first tip off. So if I was looking at this particular market, first tip off I see is that when the option set off, the buyers had all the strength, or had the strength. They were the dominant ones in the market. That's obvious kind of to see, because you see buying power come into the market, right? Now, a lot of times, many a times, you can pick a trade just off of that information alone. But that information alone is not enough to make you a consistent winner. All right? That's just one little piece of information, right? One little tip off, one clue about what the market is doing. All right? When we are in the market, always, this is always about price action. It's not about anything else. If it's about anything else, it's about psychology. And psychology is built into the price action. So what we are reading is the minds of the people with this, which is mass psychology. All right? So I'm not going to get too theoretical because I want to keep this very practical for you. Right? But that first minute and a half is showing strength in the market. Right? They were buying. Right? So that's not enough, like I said, for us to just hop into a trade. We can do that sometimes. Yes, we can do that maybe sometimes and win. And if we, don't do that often, we'll be okay, actually. We could, if we were just riding blind and just taking that one little tip, we could do, some damage just with that alone, right? But we're price action traders, and we're not going to just go into things blindly just based off of one little piece of information. We actually know how to read the context of it all. All right, so let's actually do that. Take a step back real quick just to show you what was going on from about 7 o'clock. Well, before I do this, let me go through all of the tips first, and then we'll go through little details. I believe that's a better way to do this. That was the first tip. What's going on in that first minute of movement? I need to know that. Right? The second thing I need to look at with this is I need to constantly be looking at what both sides of the market are doing. Right? I need to understand what both sides of the market is doing. Now you say, well, I'm just looking at, my buy right here. What's the big deal? Why would I need to know what both sides are doing? That's important though, because even when everything is set in line with like the dominant pressure, even though that sets up that doesn't mean that things are guaranteed. It's no guarantee. All right. So let's go further into that right there. That's important. What's so important about this price action information that we're seeing here is that this core principle is going to be repeated over and over again on any chart, right? It's going to be repeated. The first minute movement, the pressure. All right, now we're seeing right here that at the time the buyers being dominant in the market, right? Okay. Now I'm going to show you something very important to me. I talk about it all the time, right? No trader can just take his own trades in the market. See, we're all dependent on the other traders in the market also. So we need to play our game really smart. And before we put any money at risk with anything, trading event that goes on, we need to know whether we're going to get a level of follow through on what we're doing. And for us to get this follow through that we want, we need actually assistance on both sides of this market. All right? Because if we don't get both sides, assistance from both sides of the market, the opposite sides will be hopeful. And if it's hope for the opposite side, that means that you're going to have two-way trading. As soon as you have two-way trading that is balanced, it's going to stall the price. And if that continues and the opposite side has one more order above what your side has, the price starts to slip and go against you. All right? So we need both sides to participate, or this action that we're looking for will be false. This will be a teaser or like a false move, right? So we have to look for what we consider to be follow through on this. Because as we look at this right now, right, we see this market go up in this first minute. When we see this red candle come here, right, when soon as this red candle, we know that two-sided trading has taken place. Right? Two-sided trading has taken place. This gave the sellers a level of hope. Right? This might have gave sellers a level of hope. So let's go further into that. When we're watching this first portion of the binary option trade, right, we don't get into that trade there, as we keep mentioning, right? But instead, what we do is more so we're kind of anticipating that it is going to follow through, but we need more levels of confirmation, right? What we like to see in this particular scenario is that a break and a follow through is a point of structure that is building up, right? It's building up. The best opportunities really stem from places where there's a visible fight over that breakout price, right? You get these number of alternating bars, bulls and bears that are actually fighting. Like you'll see the battle, and that will help you recognize the sweet spots and show you the high odd trade. And it will do it all the time, over and over again. But before you can have that confirmation, you have to have the understanding of what the other side is looking like. What the other side is looking like. How much selling is going on, and where is it going on the other side. All right? Because conditions are always what's important. Even if everything's set up, with the dominant pressure, it could have it could fail if it's poorly like set up. And what I mean by that is that if there is, two-sided trading really coming into play, heavy, then you would see it. You will see it. It won't. Right now, we just see two. You just see these two red bars. You will see more of that play in it. All right. So that's tip number 2. I mean, I hope I explained it enough. That level of tension, because this fight right here brings the strength into the market and decides who's really dominant, right? So if you understand what we did in these first 2 little tips, what did go on? Price jumped out at the bell, price jumping on you. And then what we also see while price is jumping on them, we also see that it was a battle going on. There was a battle going on. Price did not just shoot all the way up, right? You kind of don't want price just out of nowhere just to shoot up and then you just take that trade, right? Like if this battle did not happen and price was all the way down here somewhere and just shot up and it was over 91, like that's not a trade I would take. I want to see the battle first. So I want to see the origination of the battle first. So now this allows me to understand what the dominant side is doing at the time, and then I can start seeing a response from the other side, because depending on what that response is will determine how we're going to move in the market. So this is like the concept of what we would say support and resistance. The general idea is that the levels in the chart, right, where prices previously bounced away from, we're expecting it to do the same thing. That's all that we say with these levels. Everyone kind of in the market kind of knows about these levels, and even though they might know about them, they might not know how to use them in a trade properly. What's interesting about these levels, these boundaries, like you could see that there was like a fight at this 91. There was a boundary there. Once these levels are broken, they usually follow through. All right, that's important to know. Once you see the fight and you're seeing what the dominant side is, you're seeing a response from the other side. Now, what are we looking for after that? After that, this is what I look for. I'm going to give it to you. Hold on. Before I go on to the next tip, I just want to go a little bit further into the thinking on the other side of this market, because I believe it's important. The only reason why, we consider, if you want to, support and resistance, that word, the only reason why that's even important or even considered in the market is because we're always looking to find out where the dominant pressure is in the market. We want to know what side is dominant, because the dominant side is going to have the most volume, it's going to have the most strength, just period, right? So the thing about that, though, is that just as we are looking on this side, the people that are looking contrary to us, they're just as smart, and they're looking also. So as we are looking at what the dominant pressure is doing, they're looking at any weakness that the dominant pressure shows. And as soon as the dominant pressure, they believe the dominant pressure is showing weakness, then more orders might come into the market, because they're playing the same game you're playing, but they're playing it from the opposite position. All right? This is where things get exciting. But of course, since they're playing it from the opposite position, one side eventually have to run out of ammo and strength, right? So whichever side runs out of strength, they got to give up the goods. And this is where we get the follow through we're talking about, right? So right now, if we were looking at this and the sellers, we saw the sellers come into the market, right? You know, they're looking at the same thing we're looking at, right? We're looking at the same thing. So when they come into the market and then they see that they couldn't move the market past this 91 point, they start to give up hope. And now the buyers start to get in. And now when these people start giving up hope, they have to get out the trade. What do they have to do to get out the trade? They have to buy to get out the trade, because they're selling at this point in time. So when they get out the trade, they're buying, adding to the buy offers, which will create the follow through that we're looking for. All right. That's what it's all about. All right. But it has to be set up properly. Right. Because many traders is on the contrary side of this, looking for weakness in that dominant pressure so they could jump in there, right? But if a break is not built up properly, like we're saying, chances are it's going to fail, because it's not going to be able to convince everyone at this point that it has the strength to move on. All right. Right now, we see a good little battle going on, so we're good. Or we believe that we're good, right? We have two things going in our favor, all right? But we can't just rush into there either, though. We can't just say we got those two things in our favor and we're good. Because a lot of times we can see prices doing just what it does, follow through a little bit, and then peter out, and then just fall through. Regardless of how all these things will play out in the situation at hand, a poorly set up break is going to stand a very high chance of failing. Simply because people that, are looking for that breakthrough, they know what to look for. So if they don't see it, they're not going to participate in the market. And then all the contrarians are going to participate in the market, and that's going to bring the price to your strike and make you fail. All right? So now let's get on to the fact that we now have sort of said that we see where the origin, right, of the dominant party is coming from. We see where that is at, right? We see that origin. All right. Now, I want to go further into this, but I'm going to make another more advanced video about this, because this has to do also with really with Forex and where people place their stops and where they're looking to take their profits. That tells a lot also about this pressure. All right. But for now, we're not going to worry about that right now. We're going to say that we saw this nice fight, right? We saw that they tried to jump in there and they didn't really get any strong grasp. And at 91, they couldn't move the market past the 91 mark. All right. So let's leave that where that is at. Right now, as soon as I see all this going on, my third tip off. Let's look at my third tip off. I go by the 4-pip principle. Right? The 4-pip principle, really, really simple. says that the Forex market is driven by like institutional traders. Institutional traders, and there's also a lot of day trading going on the Forex market. With that being said, institutions are working just to fill their orders at the best possible price. And they will buy in many pieces as the market continues to go up. We're just talking about buying right now. It's the same difference if it was selling. So as the market goes up, they're going to be buying in pieces. Also, a lot of this trading is going to be done by computer algorithms. And it will all end after the program's complete. So going up and down, these programs are buying and selling, and they are competing with all the other algorithms and programs and companies, and even some companies have, programs competing within their own company. So everything is kind of run by computers now and logic. All right. So on the speed tip, we can never, outthink them or beat them. What we get to do is that we know that these large institutions are pretty much responsible for moving the price. Since we know they are responsible for moving the price, our only goal is to stick with them and not do anything against what they're doing. And to be able to do that is price action. That's the clues that we are looking at. These tips that we are looking at are not you and me in the market. It's these large institutions, right? And yes, most people already know that, but many times they don't know that these Forex day trade firms, they trade substantial volume. And for their trades to be profitable in the market has to move many ticks, not just one, or a fraction. It's a big reason why you see a lot of people, like a regular person like me or whatever, might be good at trading Forex or whatever like that, but they're not at an institutional, they're not trading institutional money, because institutional money, it has to scale. Whatever you're doing has to scale very, very big for them to even consider it. So that's a whole nother subject. But anyway, what this institutional money though will do is that, since they like to buy in chunks, the market would move in chunks. So speaking of the Forex market, the Forex, when they start moving the market, usually it will move in 4 pips, right? That will show itself on Nadex in 2 pip moves, all right? So it moved 4 pips in Forex, and on 2 pips, I'm looking for in Nadex, all right? That's very important to me, because these institutions, they're only going to risk their capital and enter into the market if they strongly believe in what they're doing. They can't have the market go 15 pips against them if they're trying to, eke out 4 or 8, pips. So they will only enter when they feel the risk of an adverse move is slight, very small. So if you read their activity on the charts, you're going to likewise be confident in your trade. All right? So knowing this, once I start seeing the dominant pressure from the start, I'm starting to use that 4 pip principle. And I said it shows itself on 2 pips on Nadex, right? So right here, I'm going from 89, well, this is about 90, right? I'm saying this price is going to move from 90, and I'm going to forecast to about 92, right? I'm going to say that's like the range of this particular move, right? That's because that's where the buying started at, right? That's where it started at. And if we could see all the way through here, we see, it was at 90. Even went down, stopped at 90. You see the strength of the market come back in at 90, move the market up to 91. We watched and saw what the other side did. How did they answer? Kept at 91. Now, my 4-pip principle says from 90 to 92 the market should move. If it gets up to 92, from 92 to maybe 94 the market should move, depending on how this swings. Actually, so I'm looking at this from 90 to 92. That's where I'm believing the market is going to move. That's how I forecast how the market is moving, with the 4-pip principle. And that's very simple. Like, you don't have to make it any more difficult than that is. That's just it, knowing that. All right. So now, once again, I'm got more confirmation that I like. Market tip 1, the beginning movement, beginning of the binary. The tip 2 was this false area here. What the response of the sellers, right? Now, going to tip 3, we're looking for the 2-pip range on the 4-pip principle, right? At 90, we look for it to go to about 92, or at least try to make it to 92. That's the important thing. That it's attracted to 92, that it's going to try to make 92. That's the important thing. That it's not going to fail at 91. That it's going to try to make 92. All right? Now, I think that's a very simple rule right there, and I'm going to leave it at that because this video is, sort of long, and I know you guys' attention span could start to wane, right? So, let's move on to the next, my next tip-off that I look for, and that's going to be directional speed. All right? Now, this is the nighttime we was in this trade, right? Usually at nighttime, you don't get that much directional speed. Usually you get the most directional speed that I like in the daytime market, the U.S. session in the daytime market between 9 and 11 o'clock. That's when you get, real strong moves in the market. That's actually at a time when our boy actually shines in doing your at-the-money trades also, right? Because you have a lot of directional speed in the market. That means that this particular trade, like 56.25, we might have been in that trade if it was earlier. We might have been in that trade for like 3 seconds or some, tiny amount. And, if we set up to come right out the trade, we might have, did 20% on our money in about that 3 seconds, or maybe 30% on our money, depending on where we decide to get out if we did not stay to expiry. All right, so directional speed in the market. Usually you think about speed, you're thinking about behavior in the market. Is it being erratic? I'm not really talking about that. I'm assuming that this behavior is not erratic. We're looking at directional speed in the market. If we have nice, good directional speed in the market, we can confidently take the trade, because usually if we got good directional speed in the market, the market is going to take it for the full 4-pip principle, right? It'll take it for the full 4 pips. At the evening time like this, it might just go to the 2 pips. Like this market right here, I don't know. I'm just, saying from my experience is that maybe this market just takes its time, goes from 90 to 92, right? And then starts to fail again at 92 or whatever. Never, takes hours to get to 93. In a speedy directional market, it's going right to 93, right to 94, right? Then might fail coming at 95 and come back down. You see what I'm saying? Then start buying back up again. All right. That's what I look for. This 4-pip principle, might start all over again. It might go in this from 90 to 92. Like I said, might fail or whatever it does in the meantime. And then now if they might start buying up from 91 to 93, and change up a little bit, depending on the conditions of the market. It's all depending on the conditions of the market. Like, you can feel one way about the market at 1 minute and the next minute feel exactly the opposite, depending on what each side is doing. And that is important, that you're understanding the psychology that's going on both sides of the market. It's very important. I guess the fifth tip off that I use a lot of times is this: multiple time frames and construction of how the market actually looks. Let me explain. Let's say if I looked at the 15-minute, and let's go to about that 7:15, right? 7:15. What am I looking at? At this 15-minute chart, what am I just looking at? I'm just looking at the fact that it's a small little increase going on right here, right? Price seems to have gone down, right? Earlier, hit a wall, right? And now price starts to go up a little bit, and I'm just going to be with that. With this, I like to always say birds of a feather flock together. And what I mean by that is, while one candle is going to look like the candle before it. Like, you see all these are little dashes. They all flock together. See, all these are blocky. They all flock together till they transition. Then they become dashes, right? Transition, it's not always going to be exactly, but what I'm saying is the market, the behavior, the speed, all these things, they're so correlated that usually from candle to candle, they're going to be homey, homey stromy, you really know me type thing. They all going to be birds of a feather kind of flock together. See, these are, mostly cubes. These are mostly crosses. All right. Now, that's the 15-minute time frame. I usually like to look at that to see what the market is doing, has been doing. So if I'm looking at this, I'm on this 15-minute one right here. I'm thinking to myself that I know it's going to be a little shaky because the last candle was a little shaky. So I expect this one maybe to have a little jitter in it also. But I'm looking at it where it is at in comparison to the candle before it, right? I'm looking at that also. So then I'm making my prediction that has to line up and be confirmed by our boy and the price action and all those things, that it's going to continue with its little with the up move that it is in. So at that point in time, I might hit the 5-minute bow. This is not what I'm looking for. All right. Oh, shoot. I did that. Let me hit the 5-minute over here. Okay. I hit the 5-minute, and let's go to the 7:30. This is 7:25 right here. This is the one we were in right here. See, it's a upward movement. If you look at the candle before it, you see the candle before it is, it's not a dash, not exactly a cross, it got a little block to it. So I figure this next candle be something sort of like it, right? And it is what it is. So that's what I'm looking at the 5 minute at that time. Then I hop down into the 1 minute or 1 minute agenda, right? And let's go through that a little bit also. So we go through that a little bit. We see this at the 1 minute mark. This is at the 1 minute mark. This is kind of even late in it for at the money trade, really. But it's in the evening time, so it's a little different movement. All right. I don't think this was the perfect trade, but no trade is actually really the perfect trade. It's a winning trade, so we're good with that, and we got almost everything we wanted in the trade. Thing with me is that I trade my strategies, setups, price action, and I trade it based off of experience and statistics. So when I see it set up, I usually just, I'll take it, win or lose, because I know I'm going to win just more times than I lose. And if you're taking the at the money trade, I believe that's a good way to do it, because if you're going to win more times than you lose at that trade, then you might as well go for it, because you're losing a lot less than you lose in the money trade. And the process of going through all this is just the same, really. You see right now where the price is at with 58 seconds. If you was in the money trade, the price would just be higher at with the same amount of time left. All right. So all you doing with the money trade is waiting longer and getting another point of confirmation inside the trade. That's all. So it's essentially doing all the exact same things, right? But it might happen a lot quicker, right? You might have to make some real quick decisions, and because you're not used to doing it, your confidence will be at a low, because you're not used to doing it. So once you get your confidence level up, you're going to be able to perform, flawlessly also. So know that. So we have 55 seconds left on it, and you see the price. Every time the price drops down, it stays above 91, right? So we can believe that the market is going to go to, about 92. That's what I, was looking for. I know at this time market like to hit like 916 and hang around there. 913, hang around there. That's at the 7:30 period. That's just how it kind of moves. Usually, not all the time, right? Everything could change. You see, it's at 912 right now. Once I saw that, I was a little, I probably was a little, but risk reward is so good on these that we don't worry too much about them. See, 916. This is what it was looking on my other charting out, right? On my trading view chart. This is what I was looking at there. Let's stop that right there. You see our boy shows a green line indicative of a buy at this, in the market, which it was. And we look at the price action, we see for a momentarily the market had dipped down, right? But it dipped down to that 90 point, and this shows it like perfectly what I'm kind of talking about with the 4-pip rule, 4-pip principle, how I like to use it. You see this, if we looked at this price moving up started from 90. I suspect it's going to go from 90 to 92, right? At 92, look what happened. This is where two-sided trading starts to pop in at 92. That's why I felt so secure at 91, right? Because of this whole action. It's the context of everything. It's not just one piece of information. It's the context of it all right? I noticed this video was awfully long probably, and hopefully it was valuable to you and clarified some information. If it did not, feel free. You can always feel free to contact me, ask me any questions, comments, and concerns you have about how we work with our boy. We will be in the market this week, God willing, taking trades live, trade and trade, right? We will be doing that, and we'll be going over different ways to get into the market. Also, I like strategies as far as price action strategies, and I like to be able to have different quills in my bow. I like to have, different shells in the shotty for different situations, right? So I might do the at the money trade at, certain times of the day, and then maybe another certain time of day I might do the double tap trade. I might do that at a certain time. But as everything in trading is based off of the timing and the opportunity of that time, how long that opportunity exists, and whether you will have the confidence to take advantage of it at that time. Pretty simple. Yeah, this video is long enough. If you like this one, if it was helpful for you, please let me know about it. I appreciate it. And hey, best of luck, success to you with your trading. I know they're out there trying to get you, right? So you got to know what's going on both sides in the market. It's imperative that you do. And knowing how to read the price action is going to really give you the leg up on everyone else in the market, because the institution, they're dinosaurs as far as the speed that they can actually move the amount of money they need to move. So we can be very nimble, and since we're nimble, we can get a nice bird's eye view of what's going on, and then just be like that bird standing on the crocodile's back going across the river. All right, Senrico Janko, I'm the Signal. See you really, really, really soon.